Thank you all so much for joining us today. I know there's not too much news going on in the economy to come hear a presentation of our mundane capital markets, but I think we can make some interesting comments. Something struck me this morning when I woke up and I looked at the calendar and I realized this is the day 3 years ago where a client said, you know what, I don't think this COVID thing's going to amount to much. Let's go ahead and launch our property to the market tomorrow. And March 15th was the day we came to market in 2020, thinking that this would just blow over in a week or two. And here we are 3 years later, finding ourselves in yet another conundrum, nationally and globally. And we're really excited to have Matthew here today. We did not at all work together to time this, but I think it's very timely to hear his comments. I think we're going to hear about a lot of gyrations in the economy. One thing that struck me interesting talking to Jared, my business partner, this morning was 3 years ago we started to see these massive gyrations in the economy, and people have been wondering what's going to happen next, what's going to happen next. And almost like clockwork, we've done 3 transactions a month for the last 36 months, and 9 in the last 2 weeks that we have brought to market, and 2 waivers of feasibility yesterday. So I think one of the takeaways through all this murkiness is we're still in an incredible market, and I think those that see the climate through the weather and can look at long-term trends and see through some of these near-term and look at where this region is going, I think are going to be the massive benefactors. So I think a lot of the remarks today will be very foreshadowing of what's going to happen in the near term, and then after Matthew's comments, we're going to talk a little bit about some longer-term trends. So once again, I want to thank our entire team for allowing us to put this on and doing all the work. Cassie in the back, a round of applause. She makes sure everything happens, and all I've got to do each morning is learn how to tie a tie again, and that's pretty much my responsibility. So without further ado, I'd like to introduce and have Matthew Gardner come to the stage.
Hello, happy Pi Day. It's only mentioned about 3 years ago. I think roughly 3 years ago, the Lehman Brothers announced that they were not doing particularly well. So serendipity, it's an interesting world right now. I'm not sure about you guys, but I think I've slept about 4 hours in the last 96. It's been an interesting time in the national economy, obviously for reasons which we all know. I had to change some of my forecasts because of it. So is that a positive or not? Well, I guess we're going to find out that shortly. I plan to take about half my time. I'm going to half an hour of your time today to talk about what I see going on nationally, what's going on locally, as far as the economy goes. And then Dylan and I are going to sit down and wax poetic about how we see the income property market, and hopefully some other things as well. So, big picture. The Fed. I blame the Fed for everything. My kids' bad teeth, bad grades, you know it, blame the Fed. They are having an interesting time right now. Inflation. The Fed's got what's called a dual mandate, right? Full employment, check that box. We are at a low unemployment, or close to it. We haven't seen since the early 1960s. On the other hand, they also got price stability, as in stable inflation. This is core and total inflation over time. Is that stable? Again, that's only going back up to June of last year. Not so much. And so because of their mandate, their requirement for price stability, what have they been doing? Raising interest rates. And it's also my forecast going forward with the Fed funds rate. You can see here, coming out of the Great Recession, money was free. This has happened since 2008. And then all of a sudden the economy got a bit ahead of itself. Back to, what, that'd be about 2016, 2015.
To get more?
Started raising rates, and then the pandemic came along, back down to zero. And however, have they started raising them? Oh boy, have they started raising them. And they will continue to do so. The question is going to be how much. They're meeting again next week. I had forecast a 50 bip increase in the Fed funds rate. I've changed that to 25. And so that's what it should have been, in my opinion, but they were going to push a bit harder because, as you know, obviously CPI number came out this morning, higher than many had hoped it to be, kind of met expectations of 0.5 and 0.4 on core. sorry, 0.4 on total, 0.5 on core. But they are going to continue to aggressively raise rates. Now, in my opinion, as one single economist, a lot of my colleagues agree with me, and that is the Fed should have been raising rates a lot longer, a lot earlier. And historically, what they do, they wait too long to start raising rates, and they continue raising them too long, and hold them too high for too long, and what invariably happens? We have a recession. And in fact, there's only been 3 times since the 1950s that the Fed has actually managed to raise rates because of inflation and stay off a recession. Their job is price stability, but the trouble is they're crap at it. And they really are. So again, I think they'll raise rates a bit further, but that has started to change given events in the last 72 hours. However, will we see them continue? Yes, I think we will. Why? Well, not just the cost of goods, the price of eggs, short eggs, by the way. This looks at the average hourly wages of workers, year-over-year wages. High-skilled, low-skilled, and mid-skilled labour. They should be running around 3%. They should not be running close to 7%. You can see here, highest pay in terms of biggest growth has been in low-income workers. That tends to be hotels, bars, restaurants, these kinds of things. But even that is starting to roll over a little bit. And that is a positive. In fact, the job number that came out last week said we're seeing certainly hourly wages rise at a more modest pace than we had been seeing. So is that a good sign? Yes, it is. But here's the problem still. Right now, there's 5.1 million more job openings in America than there are unemployed people. 5.1 million more job openings than unemployed, as measured by the U3 unemployment number. And now, that is tough. I mean, everyone can have almost 2 jobs. But it's starting to come down the other way. Right now, we're about 9% below the peak. That also has started to roll over. Other things we tend to look at, right? Employee quits. And quits number came out, again, we're down 14% from peak. Starting to move back to some sense of normality. Layoffs, again, have started to rise. So all these things tell me that we are getting slowly to where we need to be. However, it is taking us a lot longer than we as consumers and businesses would like to see. Why is that? Well, prices do tend to be sticky on the downside. They go up very quickly, very slow to come down. But it's not just that. Price gouging is rampant right now. About 52% of inflation, according to the economic research report which I read, which was published by the Fed about 4 months ago. Historically speaking, back in the 70s, 80s, 11% price increases where companies just gouging a bit. It's more than 50% now. What we find is a lot of companies and businesses are pushing prices with great excuses. Think chicken wings. Chicken wing prices, avian flu, big issue there. Prices went up. Oh, that's being sorted out. Prices started to come down of chickens. At the same time, have businesses been lowering their prices? No, because they can get away with it. They're keeping them high. They're willing to sacrifice velocity for price. But I think we'll start to see it come down here. I think we will. And so this is my core inflation forecast. The hedging and finance forecast is going to come down, but it's going to take a long time. I X out food and energy, most volatile sectors. But what is causing, well, partly actually a fairly large component of inflation, I hate to say it, is shelter, not just shelter. It's owner's equivalent of rent. And so what we're seeing is the way they calculate that is they're looking at in-place rents. They're not looking at new rents. That data, in my opinion, is 3 to 4 months old. So they're looking at old data, they understand that, and it's still not showing the fall you'd normally expected to see. But in reality, are we starting to see a softening of inflation? Yes, we are. But unfortunately, I do fear, at least I did until last Friday, that the Fed was going to get carried away. And they will, because of that, push us into a business cycle contraction. Could that happen? Absolutely it could. But if you know what happened on Friday over the course of the weekend, I mean, having 100 bip jump actually drop in 2-year paper should never ever happen. It really should. But is the yield curve still inverted? Yes, it's a classic sign that we are. Economic contraction is around the corner. Yes, it still is. However, today, you've seen about a 40 to 50 bit jump in 10 and actually in 2s as well. So it's getting back to some sense of normality, but there's a lot of frustration, a lot of concern in the marketplace, and certainly a lot of uncertainty. because of the banks that went down over the course of the weekend. Why did they go down? Well, you've got to go back and blame the previous administration. Imagine that. A situation whereby they looked at the Dodd-Frank bill, and Barney-Frank, great bill was put in place after the end of the banking crisis, occurred back in '08, and they just made some changes to it. All of a sudden, to have to be submitted to the stress test, you used to have to have 100 billion in assets, they moved that to 250. And Silicon Valley Bank, 220 billion back in the day. So, no requirement there. Is there uncertainty? Yes, of course there is. And anytime you see uncertainty, what happens? You tend to find businesses start to become more cautious. And that was going to happen anyway. It's going to happen because of the belief we are going to be entering a business cycle recession. But moreover, more importantly, is the fact that next year is an election year. Markets tend to just sit back to wait to see who's going to be in the White House at that point of time. So, you think about GDP. Up until, if you listen to me speak any number of times I've been speaking so far this spring, you'd remember that I was saying, yep, we are going to have more than likely a recession. We can change things a bit, but only a bit. The great thing about being an economist is that you can't get two of us in one room and agree on anything. It keeps us gainfully employed. And that is the fact that we could see it. The options you've got here right now are one, we will enter a modest downturn the second half of this year. Is it possible? Yes. Probable? I would say not now. I think we're hearing more and more people talking in Wall Street and back east about the potential for actually achieving a soft landing, where you can actually see this go down. On the other hand, we could have growth still, no real recession. And you say, well, hang on, Gardner, we actually had technically a recession back last year. No, that is true. However, that was purely COVID, nothing else. So we could end up skirting around it. The events of the last weekend might actually cause that to be a curve. But I think that's quite likely to be the case now. So the Fed knows what it's doing. It's not going to stop raising rates. It has got that dual mandate, that requirement to take care of inflation as best it can. But I think the pace of increase, that 50 bips I was expecting at the next meeting, is now 25. And in fact, my friends at JP Morgan are thinking that we should see rates drop this year. I'm not quite sure I'm on board with that one, but again, time will tell. But as we in as bad a situation today as we were last week, I'm not worried about it, quite frankly. But the positive of it, you find a positive, is that we could actually get around and see continued expansion, albeit very modest expansion this year and next. Fed will raise rates here. I said 50 bits is off the table, B25. I think they'll probably raise one more time after this. Last week I said 3 times in total. Now I'm saying possibly 2. And the increase is going to be probably 50 to, I doubt 75, although it's possible. But I don't think we're going to continue to keep on going and raising and raising and raising. They're going to come to a plateau they're going to hold there, hopefully, probably in 3 or 4 months' time. Will they overhold or they hold on too long? That is quite likely, and especially if we continue to see GDP continue to expand in the second half of this year. Flight to safety, yeah. And bond yields have already risen again. Again, we saw a massive drop. That's starting to change already. And I expect we'll come back to what was perceived to be normal, which makes no sense when 2-year yields are a point above 10-year. That makes no sense. But we'll get back to that point more than likely, because the concern of this spread of banks going under will probably end up not occurring. However, will we start seeing more money move into the big banks? Absolutely. We see some regional banks start to combine themselves, continue to look at that as an avenue, a viable one. I think that we will. But it's something else that worries me. It's the debt ceiling, and it really does concern me. We owe about $31.4 trillion, give or take, right now. And every time we've hit that ceiling, we've managed to raise it. But now we have a different makeup in Congress. Now all of a sudden one side of the aisle is saying, maybe we should just not raise it. They've got their eyes on Social Security, Medicare, and Medicaid. Now, do we want to break the ceiling? No. If you want to see really, really, really bad things happen, 4 horsemen of the apocalypse type things happen, break that debt ceiling. Nothing good will come from it. And again, it acts as a point of uncertainty in the business sector and globally as well. You have to remember that We are the largest owners of our own debt as a nation, which makes sense. Second largest owner is China, third largest owner is Japan. Now, if all of a sudden the full faith of the government-backed bonds goes away, do you think interest rates will rise to accommodate that risk? Oh, you bet they will. You want to see mortgage rates on houses triple? Yeah, that will happen. I kid you not. However, before I get too worried and wanting to go running off and finding a glass of vodka somewhere, we will. It will happen. Now, here's the thing about politicians. They will end up taking it to the last possible minute. The Fed can use what's called extraordinary measures. We can continue to pay our bills until sometime midsummer, but at some point they're stuck. But what will happen is, at the last possible day, last possible hour at midnight, you'll see all these politicians coming out from the rotunda in DC, wiping their furrowed brows, saying, "We did it. We raised the debt ceiling. Aren't we great?" They could raise it tomorrow if they wanted to. They won't, but they could. And unfortunately, again, it is that uncertainty which can cause a slowdown in capital investment, and a lot of bad things can occur. Will we raise it? I think we will. I have no question about it. But again, it's just another level of worry in the marketplace, which has an impact naturally. So where do I see the nation going? Again, give or take, we could have a very modest recession. We could skirt it. Still a bit too early to tell, given what's gone the last week or so. However, I think it's more than likely that we will probably get away with it. But even if we do enter a recession, it's not 2007, it's not 2000 .coms, .bombs, whatever you want to call it. A lot like 1990. Very modest, very mild. Unemployment rate will rise, but given how tight the labour market is, it's unlikely to get, I think we'll probably peak at about 5%. Oh, woe is me. So even if we do see a cyclical downturn, it's nothing too much to worry about. All right, how about where we are here and what's going on in our economy? Now this is my state-by-state forecast for employment growth this year. Again, relatively decent growth. Nevada's doing pretty well, thank you Vegas. It really is going to, all of a sudden we are going to spending again. It really could quite remarkable. Will that continue? That's what we'll find out about fairly shortly. But I suppose it's been pretty good across the board, especially in Colorado. Slower growth on the West Coast than we've been used to, but growth all the same. And this is accounting for the fact, even if we do see a turn down nationally, I certainly think our market here will be somewhat protected. But that's state by state. If you look at the West Coast, the major metros in the West Coast, this looks at jobs lost to COVID and jobs recovered. Oops. And you can see here, I mean, we're getting almost at Los Angeles. I've been watching that for the last 3 years, see whether they've actually recovered all the jobs were lost. They will. Vegas is doing well. So a lot of metros have done well. And the smaller ones, quite frankly, look at Boise. Everyone's talking about Boise right now. It's interesting. And then those other Zoom towns, like Austin, Texas, Boise, Salt Lake City, where people have moved to, a lot of them having moved from California. And saying, wow, this is great. I just sold my one-bedroom use house for $3.2 million. You are cheap. Housing, ownership housing in Boise, Idaho, has tripled in cost in the last 3 years. 3 years, tripled. Where you could buy for $250,000 in 2019 is now $650,000. So we've seen some significant, and quite frankly, they ignored COVID. They lost a handful of jobs, got them all back the next month. So growth here is good. If we look at the change, Vegas again, hardest hit naturally, leisure and hospitality, massively impacted it. But look at us here in Seattle, over 4% growth. Again, it's a 12-month look back. So we are doing pretty good out here in the West. Now, the country's doing pretty well as well. But we talk about those movements and migration and the job basis of our market, certainly here. We've performed very, very well, but there are some issues out there which I think are worthwhile talking about. So if you look at the Denver State, again, similar situation, jobs lost, jobs recovered. And most markets, other than Bremerton and the good old Skagit Valley, not sure if anyone, don't anyone actually do any work up in Skagit Valley? I didn't go there because I've got to drive through it. Obviously, it's a small market. Bremerton, again, exposure to the Navy. But in general, every other market, every other metro area has recovered all the jobs and added a fairly significant number more than that. Unemployment, high. For some reason, Yakima always seems to be high. One of these days I'll be able to figure out why that is. Again, this is non-ag, but in general, 3% unemployment here is taken through December. because all metros haven't reported your settlement for January, but want to make sure it's equal. Again, basically, other than Yakima, at full employment. So we've been doing pretty well here. Have people been moving here from somewhere else? Oh boy, they have. Where have they been coming from? California. It's not just the Austins, the Salt Lakes as well. A lot of people from Northern California, not Southern. Southern's interesting. Actually, people in Southern California are going, mainly out of LA, they're going east to Riverside or south to San Diego. North part have been jumping on I-5, or the 5 as they call it. A few of them coming up, stopping in Oregon, the city ones. The rest are continuing across the bridge, which will fall down, by the way, across the Columbia, and ending up in Washington State. They like it. Why are they moving here? 2 reasons. 1, taxes, both income and property taxes. And number 2 is climate. They're getting sick and tired. Forest fires, floods, pestilence, disease, Newsom, who knows. Anyway, so they're leaving the state, and they're coming through. Now, because of climate change, which is becoming far more important, but have you noticed here, our weather's getting better. We are becoming the Riviera of the Northwest. As weather improves here, people want to be here. And that is not changing. And they're also looking at where the good jobs are. We are certainly a market that people want to be in and want to see expansion in. So here in Tacoma, those things you look at, again, jobs are starting to come. Again, they've done very, very, very well. What I want you to look at is one at the bottom, information. So, lost 1,300 jobs, rounding error, quite frankly, added on over almost 11,500. That number actually, up until a few months ago, was almost 20,000. We've seen some cutting, there's some worry about that. We say, oh no, what's going on? Well, so the tech sector isn't quite as vivacious as it was before. Is this going to have an impact on our real estate world and our economy in general? I'll talk about that in a second, but when you think about the Tacoma market, again, similar situation, far smaller market as we know. A lot of their business sectors, again, have seen a full recovery. Information, again, not a big market there, but where we have been being hit in our market, quite frankly, is because of aerospace, because of Boeing. And that has been a drag. However, all of a sudden, announcement today, Riyadh, new airline, Riyadh Air, just announced the purchase of another 36 Boeing planes. That's about 10 o'clock this morning. And then on top of that, got a massive order coming out of Air India, which is split between Boeing and Airbus. I think the future is going to be good in the longer term for aerospace. The question is going to be, is it going to be here or is it going to be in Carolina? And that, I think, is what has a lot of people just a little bit concerned, but quite frankly, our diversification away from aerospace into other industry sectors has been a bit of positive. But we talk about information, it's worthwhile doing it. So let's look at an average number of jobs in that sector over time, 74% roughly, 70% increase in the last decade. They have been growing like weeds. Why? Well, thank you, Amazon. I'm not sure about you guys. I was buying toilet paper on Amazon back through the height of the pandemic. They were hiring a lot and hiring and hiring and hiring. So are we seeing some modest contraction now? Yes, it's really quite frankly the cutting of the fat. It is something we should be worried about. I don't think so. And here's why. If you decide to lay off as a large company more than 100 people, you have to tell the state. That is a requirement. And so these are the entities that have made that announcement. Amazon Health, Compass, yes, real estate, but that tends to be the tech parts of these real estate companies. Microsoft, few. So it's about 6,100, not that bad, quite frankly. But it's not that many. It shouldn't be a concern. No, it shouldn't. But my friends over at GeekWire look at companies who have made announcements of layoffs, but haven't actually gone through with it yet, haven't formalized it. That number is certainly more significant. And of course, Meta coming out this morning saying not just this, but another 10,000 on top of that going to be going away. There's an internal blog apparently at Facebook, and there's a whole bunch of middle managers who are in their mid-20s making $520,000 a year who are now complaining, oh no, I was on track to make $1 million by the time I was 30. Woe is me. Tough. That's my opinion anyway. So, but again, all these things are going to be global. So yes, Amazon's he's going to see a contraction, that's fine. But it's not just in their tech space, also in warehousing distribution as well. But there's still 72,000 people working for Amazon in Seattle. Now they will be making their announcement formally come May in terms of their return to work policies. And that's going to be interesting to see. There's already significant internal pushback. This all started with a return to work. Started actually with Bob Iger over at Disney a couple of months ago, said, okay, everyone, 4 days a week in the office minimum, don't like it, leave. And a couple of weeks later, Starbucks made their announcement, minimum 3 days a week, including a Tuesday and a Wednesday. And so I think we're going to see more and more companies start to formalize their requirements for returning to work. Do they want people back to work? Oh boy, they do. Do the workers want to go back? Oh boy, they don't. They are very happy in the bunny slippers, rolling out of bed, down and doing their work. I'll try you guys, I must be old. For 5 months I had to work at home. I hated every day. Literally I was having to duct tape my cat to the wall. I was giving speeches on Zoom, but then past my cat you really didn't want to see. I wanted to go back into the office. I was giving a speech to the Business Journal, Puget Sound Business Journal, a couple of months ago. I was saying I didn't expect to see an economic contraction, a recession. I was being applauded. Like, what kind of weird world is it? I know they read the Business Journal, but why are you happy about it? And speaking to them afterwards, they said, well, Matthew, here's the deal. We're trying to get people to come back to work. And our employees are saying, no, you can't make me. You try making me, I'm going to go down the street to the guy next door and work for him, and he will pay me more than you. So there. Well, we see the economy start to slow, and then all of a sudden the shoe moves onto the other foot. And all of a sudden, people are being a little bit more engaged when coming back to the office. But when I say, are we ever going to go back to 2019? 5 days a week, no, that's gone. And that's gone forever. So it's going to be fascinating in terms of its impact on the housing market, both ownership and income. Now, when COVID first kicked in, I was being asked by a lot of reporters, okay, well, what's going to happen, Matthew? Are we all going to move to Yakima? No, we're not. Got the resurgence of the suburbs, absolutely, is something we saw. They were coming out of Seattle, going out to more the periphery of King County. Look at the gentrification that's going on in Lake Forest Park, Mount Lake Terrace right now. Or even south of Bury. Or they're going to go further out to Snohomish County, to Pierce County, out to Kitsap County, mainly North Kitsap County, not south of Bremerton. I'd like to see Bremerton do a bit of a better job, but it requires one thing. The passenger-only ferries not to break down every day. If it did that, I think they'd actually be a bit more with it. But we have certainly seen the resurgence of the suburbs and a resurrection of it. And I think that is something which we are going to continue to see. And that's got implications on the ownership as well as income property market, certainly. Incomes, again, it looks at the Tri-County area. Well, see, it's my 5-year forecast. Decent growth, but not as much as you would like to think would occur. A lot of those wage increases have been pulled forward because of inflation the last couple of years. As the economy starts to slow, I think that businesses are going to start just retrenching a bit on their ability to pay people what they want. Certainly, it applies to the fact that they start seeing unemployment rates start to rise. And that, again, puts the onus away from the employee and back onto the employer. But it is going to be positive. Unemployment, though, again, we're at 5% in Pierce County, 3% in Snohomish. That's pretty darn good. It's above the high of 2.4 that we saw a few months ago, but it's still full employment, absolutely. So right now, the employees still have, to a degree, the upper hand. But the question could be, how long will that continue? And as we move forward, we suddenly see, again, in both markets, an uptick in the unemployment rate. And it's actually not due to an increase in the civilian labour force, which is interesting to see, but for lots of other reasons. But I do expect that to continue to tick modestly higher, irrespective of having a recession, technically speaking, or not. Employment growth, though, will be positive. Now, not that many, quite frankly, in the metro area, 13,000 jobs, well below the long-term average, which is normally 30 to 40,000. But again, because of that slowdown, and because of the layoffs impacted those, that sector, but it's positive, not negative. And about a month ago, I was forecasting actually a loss of about 8,000 jobs. That has turned around, given the new dynamics that we're seeing today. And down in St. Pierce County, again, adding some jobs. What's interesting about Tacoma, again, having been around here long enough, every time Tacoma says it's going to grow too quickly, it's going to get, it's our turn now, we have a recession. It's kind of like every time that Saks Fifth Avenue says it's going to move into Seattle, we have a recession. That site, they looked up on 2nd and Pine, they looked at me, donkey's ears. I don't actually, I put one of my kids through college. But literally, Every time I think about opening up here in Seattle, bad things happen. Is that likely to continue? Well, no, I don't think it will. But Tacoma, what's interesting about that market is that it really does want to be something. But economies and certainly employment growth tends not to take big leaps, big jumps. It tends to be a ripple. And as it ripples out, it's likely, well, you know, we're getting closer to Tacoma. When Michael Chris gets leasing on his Lake Washington office building, then all of a sudden Tacoma could be next. And I sincerely hope that he does. But I think they certainly will start seeing them come onto their own as an autonomous entity sooner, I believe, than ever it will. And we're seeing before the pandemic some more interest in startup companies looking to the Tacoma market as opposed to Seattle. So we'll see some growth, but the market as a whole, will grow. Yeah, I mean it's below par growth this year rather, but still I'll take a positive as opposed to a negative. Where I think we'll see actually a lot of those contractions occur are going to be down in markets like the Bay Area and certainly the Midwest as well. Biotech though, I am bullish on biotech, and that has implications for the income property market. Why do I say that? Well, I live in Queen Anne, I work on Lake Union, I walk past 2 brand new biotech facilities that are completed right now. As you all know, or likely I'm sure do know, biotech's expensive to build, and remarkably expensive for HVAC and earthquake proof. So where we could see some fallout in traditional technology, biotech could be a replacement. We are the fastest growing biotech sector in the nation. We are not the largest, as we are San Francisco, Atlanta, or Boston, but we are the fastest growing. Now what's interesting about the biotech guys is that if you work in that industry, you're generally brought in to do a particular job and then you go away again. So they tend not to be owners, they do tend to be renters more than anything else. And I honestly think that an entity based in Seattle will find a cure for a form of cancer in the next 5 years, I hope. So I think that's a market and a sector which, yes, it's either got more money than Croesus or it's poorer than a church mouse, and I get that. But when they have money, I think that they do want to be here. Why do they want to be here? We are smart here in Seattle. In terms of bachelor's degree or higher, we have the largest percent of the population with a degree than any other large city in America. Big number. That's why companies do like being here. We might be in the middle of nowhere, Pacific Northwest, wherever. It takes 3 hours to fly to, whatever. But people do identify this as being a market they want to expand into. And so technology, biotech, traditional technology, it's something going to be a big thing. And we always worry about Amazon. Well, now knowing the fact that they are going to be moving into the Schnitzer building in Bellevue, it's going to make them, within a year, maybe a year and a half, the largest single employer in Bellevue. Kemper's going to hate it on one hand, and you'll love it on the other. But it's not just Bellevue. The expansion on the east side, that is going to continue. I mean, they've got the low Earth orbit satellite group out in Redmond, advancing in Kirkland, so I think you're going to see the east side really being an area locally, which I think is going to do remarkably well. Will it be to the detriment of Seattle? All the time will tell. Maybe we'll talk about that in a minute. Return to work will pick up momentum. We'll see more of that occurring. That again can drive some decision making on where people choose to live. I was half joking when I said Yakima. I mean, there are people who are still sat on the fence, not knowing if they have to come into the office 2 days a week, 3 days a week, or never. And when they get clarity on that, then I think some additional decisions will be made that are going to have implications across the real estate ownership of residential market, certainly. Yeah, this year it's a reset to a degree. We're coming out of COVID, and I think we can come out with a charge. We like to think we're special here in Seattle, but to a degree, in some respects we can walk to the beat of a different drum. In other respects, no, we kind of got to go along with the national headlines. But ultimately, more than likely we'll see a modest expansion this year, and we'll get back to a more normalized market, I believe, in 2024. And so with that, I'm going to hand it back on to you. We're going to have a chat, right? Right, let's have a chat. I hope you don't see this, I'm sorry.
We can try to move the podium, but next time I tried something like that, I threw up the back. Too old for this.
You want to see one? Seriously?
So for those of those of you that don't know that Matthew didn't always live in the single family world, when did you start analyzing the property market, apartment market?
Oh, yeah, Lord. Mike Scott days. 1997. So 97 through 2015.
And so not to date you, but you've been through a couple of cycles?
Oh, God, thank you. Yeah, I'm old. So, here back then.
Predates me. I think a lot of what we do is, I'd say, those of us in this market, 2015 through 2017, you could just look at any newspaper or journal and see good news. We were just looking 5 feet in front of us, and everything looked great. So we were building, we were growing, but it seems like for the last 36 months, we haven't had more than a 6 or 8 month run of just seeing bad headlines. But the challenge I see it is the average ownership term for commercial real estate is about 5.5 years. So we're owning in long-term cycles. And what I'm getting at is there's very few people who are coming out with a strong opinion on where interest rates are going to be 2-3 years from now. And so I'd just like to get your thoughts in the longer run, where you think we're headed nationally, because that will impact us here in Seattle, where rates are going to land.
Right. Wow. Well, it is interesting. Again, people can't agree about anything. I read a paper, I think it was JP Morgan put out, I believe, saying that they expect the terminal rate on 10-year bonds, which again, so many rates are based off, 4%. I just don't see that happening. I mean, if you know, without getting kind of too technical, the yield on 10-year paper is based upon the economic potential of an economy, in essence. So it's a gross national product. And that presumes a terminal growth rate of over 3%. I don't see it. So I think we are well above that now. And again, you've got that, what's that? It's the second version of taper tantrum right now. We've got yields on 2-year paper at 4 the weekend, at 4 and 3 on 10-year. Or was it 4 and 5? It was upside down, basically. So I think that we're ahead of where we are now. I think that we will see, as the economy starts to settle down, I think the bond yields are going to they'll revert themselves to get back to a place that they should be. That will take a while yet. So I think we'll get to a more normalized basis hopefully by the end of the year, into Q1 next year. And in that case, I expect yield on 10-year paper to be coming in probably around, but back down to about 3, maybe slightly sub 3. But 3% would be a reasonable number.
So we could be at 3% as soon as
end of the
mid-2024?
Early 2024? Yeah, I would say, depending again on how badly the economy goes on this year, certainly Q1 next year would be a reasonable number.
And so in the property market, there's been this thought that cap rates aren't directly correlated with interest rates, but once interest rates shoot up to the 4s and 5s, cap rates that were sub-4 have shot up. So I'd say if interest rates are going to go that low, the other side of the question is, are we actually growing rents?
Well, and that's the thing. I mean, again, if you look at cap rates, we start seeing cap rate decompression based on lower expectation on future rents, right? That's the way the math works. You've had a big run on rental rate growth the last couple of years, as you are all fully aware. That is going to start to normalise. In fact, it already is starting to normalise. Again, the issue with the Fed is they're looking at in-place rents and not new rents. And if you look at new rents, then in most situations across the country, we are seeing those pull back fairly significantly from the remarkable rental rate growth we saw. Now, the issue with Seattle is that we're always creating forced renters because of our housing value. If people want to buy, and certainly look at the younger millennials who are still renters, you have a Gen Z behind that, who ultimately do want to become buyers, but they're looking at a market now they can't afford to get into, and they're looking at mortgage rates which are double their expectations. And they have an interesting little tidbit of knowledge. A millennial has never seen a mortgage rate above 5% in their adult lives. Never seen 5%. It's amazing if you think about it. So looking at where rates are now, saying, these daylight robberies are egregious. No, it's actually remarkably low. I'll take you back to the 1980s, we'll talk about how high rates are. But we are creating that forced renter because of the fact that we're not going to find that normal turnover of housing stock, ownership housing stock, because 90% of homeowners have got mortgage rates down in the 3s. Why would you sell? So that limits supply, which means that actually causes price stability. But the one thing for apartments is that I do not see a systemic drop in home values, which is what could be needed in order to get that first-time buyer that was renter wants to become homeowner into that world. So if you create forced renters, then they are making decent money, and you can start pushing rents a bit further. But supply is going to be the interesting question, I think, over time.
And in looking at that further out, and I remember pulling a CoStar report, this was probably March, April, May last year, and they were showing 4%, 5%, 6% rental income growth going into 2023, 4, 5, and 6. And then all of a sudden, Russia, Ukraine, fast forward to midsummer, late summer 2023, it flatlined at 3% growth for the next 400 years. So the economists at CoStar did not have a lot of faith in growth.
No, I think, again, it's correlation obviously to incomes, which is important, but it's also going to be a correlation to new supply. I mean, nationally, we're going to bring on, what, 400,000 new apartment units across the US this year. That unto itself, you probably see an absorption of most of those. But if you look going forward in time, we're likely to see a significant further slowdown in the new pipeline of product for lots of reasons of land, labor, material costs, these kinds of things. And those are also remarkably expensive, which has an impact certainly on everyone here. I mean, labor, it's very hard to find labor, and it's expensive. And material costs, yeah, lumber's come down, but PVC pipe hasn't. Exterior paint is up 45% year on year. So all those costs come into, which therefore drive your rents, right, or where rents need to be. So I think it's likely we'll see a slowdown in new product delivery going forward, which again can be supportive of rental rate growth.
And I think the flip side of it is just jobs coming to this region. I want to dive into this before we talk about sort of the West Coast look in a second. One of the things we talked about a couple of months ago was the amount of job growth we had, call it 2013 to 2017, because I think we pegged around 2.9% year over year for 4 or 5 years last cycle. And I think you were predicting within maybe 90% of that this next cycle. So looking out 4 or 5 years, how much do you think this next cycle in the Pacific Northwest is going to look like the previous cycle of actual job growth?
I think it's going to be, I think we're going to do well. And again, for the reason I talked about the podium, and that is the fact we're going to see companies want to be here. They look at two things. They're a talented workforce I can hire. We're wicked smart here, got them covered. If there's an issue at all, it's going to be on salaries. Because the biggest component of anyone's salary is what's cost of living. And is that going to drive them? But if they're going to go somewhere, where are they going to go? California? No. Not Oregon? Unlikely. Now you can look at markets which are becoming emerging tech markets. Salt Lake City and Austin, Texas are two very big examples of that. And certainly, look at Austin. I mean, Google are planning a 6-block campus downtown. But I was speaking to the mayor of Austin. He's panic-stricken following the Supreme Court decision and saying, well, do they want to be here, even though Austin is a dollar blue and a sea of red that is the state of Texas? So I think there's a lot of things which companies, if they're looking to grow, they're looking at us as much as they are anywhere else, except biotech. So I think that, I think that we can weather some storms that certain other markets can't, and most of that is that diversification we see.
So looking at our market a little bit more granularly, I'd say it's been an interesting swing. I'd say go back 4 or 5 years when Expedia announced that they were moving to Seattle. We thought they were going to have to turn the lights out in Bellevue, and then fast forward 24 months, Bellevue was arguably one of the hottest office markets, if not the West Coast of the nation. We saw it dial back with Amazon pulling back. These are temporary. Where do you see Bellevue in 5 years, and then how do you see the interplay between Bellevue and Seattle?
It's funny to talk about Expedia. I go back to, date was 1999, when Symetra Financial said they're going to make their global headquarters in Bellevue, not Seattle. I thought, where? Bellevue, just across that bridge. And that was really, I think, the kickoff point. And so if you look at the office vacancy rates in Bellevue versus down in their CBD versus ours, they're half. Last time I checked. So a lot smaller, obviously. But I think that the issue we have, quite frankly, no politicians here, right? Good, okay. It is
Bar the door, Captain.
it is that the city of Seattle did a couple of things. One of which, the grand scheme of things, they went to districting, which I think was, and theoretically made sense. In reality, debacle. It's been an abominable failure. But more important than that is the fact that, again, I'm dating myself, I used to have screaming matches with a guy called Nicola Carter back in the day. I used to think Nick was that far away from flying the hammer and sickle of a city hall. But at least at the end of, when the cameras got turned off, we would sit and we'd chat. Well, the certain council member make Nick look like Genghis Khan. And so we try this experiment of adjusting a city, but doing things on a citywide, not a regional basis. That allows companies to say, well, okay, you want to do these head taxes, you want to allow this, that, and the other, we'll go across. We'll go to Bellevue, we'll go to Kirkland, we'll get out of the city itself. That's fine. And that is what I think we certainly have been seeing. That has been the emergence of Bellevue. And not just because Amazon said, well, there's great housing choices on the east side. Well, that's true, but also significantly more expensive than this side of the lake. But ultimately, I think that Bellevue is, unless you're a law firm, you've got to be closer. Like David's right, if they want to expand, they're not going to move to Bellevue, they'll open up a new office in Bellevue. But outside of law, then I think the options on the east side are significant, and people are looking very closely at that.
And, I mean, you cover most of the western U.S.
Yeah, 10 western states in essence.
In my thesis, and I'm coming from California, so I know the good and the bad. Do you think there's another market when you look at what Bellevue offers, what Seattle offers, and then what the immediate suburbs? So just having the proximity of being able to go 20 minutes away and find an affordable house from these market, is there a market in the western U.S. that you think competes with the region?
No, scale-wise, I mean, I'd say there's still interest in Boise, as I mentioned. Yeah, I mean, great regional airport downtown. I mean, the guy go around in Micron built a convention center and then gave it to the city for nothing. A cool jump's quite a remarkable facility. But again, it's remarkably small. So I think it's got legs, but again, it's scale-wise, it can't do it. Riverside, no, that's been LA. I would say, really, I can't think of anywhere. Denver's done well, but its exposure to the energy sector is far more significant than it used to be. And that can be a good thing and a bad thing as well. But think about all the metros. No, I'd certainly say, certainly in California, we are. I can't think of anywhere which would have a significant advantage over us.
And that's, I mean, our thesis in our team and looking at this market long run is reversion in interest rates with cap rates. Yeah. Where has the greatest income growth potential? I think another interesting factor, and I guess where I'm turning the conversation is regionally, where do you like? I mean, it's been concerns about Everett sort of means for the end of a dead end street. They've tried to revitalize downtown. There's been a question. We've seen major growth in Kent, in urban Kent. We've seen Woodinville grow. I mean, where do you see the opportunities for real estate investors when you're looking for that confluence of jobs, opportunity, income growth, but also availability and pricing?
Well, it's going to go to land. I mean, the bottom line is we're not making more land. We're not going to fill in Elliott Bay. Our urban growth boundaries, there's no political will at all to expand them. So already we're looking at what do we do with the land we've got. Rezoning proposal legislation being put through in India right now has a great impact on duplexes up to 4 units. It's not your kind of world, but understand the fact that we've got to do more with what we have. Downtown's still remarkably expensive. There's only so many of the family parking lots you can buy. But the question for many people is going to be, will those jobs be in our urban cores? Or is it going to be a situation whereby people will only be coming in a couple of days a week, which will allow them to live further out and put up with a lousy commute in order to achieve somewhere that they can afford? Or are we going to move, which I think we will, I've been talking about this for years now, to more of a hub and spoke model. Companies will still keep what they've got, but as they look to grow, those spokes will go out from that hub. And therefore you can actually create satellites.
And are those in other states? Is the spoke going out to Boise or is it going to Sammamish?
I think actually potentially do both. I think it's actually a bit tight to think it's going to go that far. But I certainly would expect to see greater interest in that down to Pierce County. Everett, as you said, Everett's tried it, and I don't know what people like for years on those guys. It's very, very hard to make sense of that. But I think those ex-urban markets are going to be ones who are likely to see potentially greater availability of land in our urban markets. Secondly, I think we start looking at a different product type. Are you going to start going up to that steel stud, up to 12 stories? And the trouble with the high rise, it's remarkably expensive to build. And are we going to see, people talk about conversions of office into residential? No. I mean, some low rise, old buildings possibly, but core depth and core penetration suggests that you're not going to see that occurring. So I really think the advantages that you will see, we're going to see more likelihood of greater development occurring are going to be in the suburbs, and they are going to be and less so in our urban markets. So I would say, yeah, you can say Smash with Issaquah. I think look further out to that direction potentially. Going north up into the county line, probably see more there around Canada, certainly. Windermere's an interesting bit of a nuanced market down there. Going south of Burin, I would surprise you to see some greater interest around Dash Point, that kind of area through into Des Moines. You've already mentioned Kent and Renton already.
In Tacoma, is this Tacoma's time?
Yeah, it's Tacoma's time. Tacoma's got some great functions. It's not just a pretty cool car museum, worthwhile seeing by the way. It's not just a kind of ugly dome and a bad smell, which is what Tacoma used to be. But I think that it will. It's going to take some time to get there. But ultimately, it's going to come down to value. It's going to come down to land availability, and where you're going to find those parts of land. And it's going to be increasingly hard, and therefore increasingly expensive, to look at it, let's say in a Seattle, or even in a Bellevue now, which obviously has the advantage of that being a super block, which we don't have here in Seattle.
Well, I think that the ship has sailed on Bellevue. I mean, I look at it as basically our Silicon Valley, and at some point, people jumped across the bridge and went to Oakland, and tech went to Oakland. I think, albeit further away, a further bridge to cross, if you will, that really is the next urban center we have.
For sure.
I know you're not long on Yakima quite yet.
No, I would.
We'll see if you're around in the business long enough to Yakima to be on the rise.
Yeah, I would not be coming out. Don't be burning too many brain cells on Yakima.
Well, I left a little bit of time for Q&A. I was gonna ask what keeps Matthew up at night, but I think that question is no longer relevant right now. Questions? Really?
Good grief.
Matthew, maybe talk a little bit about the Fed's 2% target and whether we care.
About the what, sorry?
Their 2% target?
Yeah.
In the, what is that, in light of, I guess the news over the weekend, I mean, it doesn't seem achievable, so.
No, I think the Fed has always said 2%, that's the rate they expected. It went from a hard 2% to long-term average of 2%. They changed that several years ago. But I think that, can they start talking about 3? I think they could, but there'll be a lot of pushback if they do, because the expectation then from producers was going to be great. We can jack prices up more, and it's going to be okay. So, and also at the same time, if you do that, you're going to get into that systemic spin of keep on raise that point again and again. If we're going to raise wages to compensate, then you get into that inflationary spiral, which you certainly don't want to be. Are they talking about it? Yeah. Mary, so I do work with the Philadelphia Federal Reserve, and Mary there, she's very much the opinion that yes, we need to look at 2%, but no one's prepared right now. We've still got far more dogs than we have hawks on the reserve. So yes, if we talked about, can we get back there? Well, according to me, I think it's going to be, we could get back to core at 2, but maybe in late 2024, maybe. But right now, as I said earlier on, it's the PepsiCo model. I listened to a great podcast a couple of weeks ago, and it's Pepsi who are they're pushing price, and they're saying they're willing to give up a velocity for price. And so so any excuse you can find to raise prices, which they had, obviously, supply chain issues and this issue and labor issues and blah, blah, blah. Well, they push prices up, and as when those things get resolved, as many of them have they been putting prices back? No, they haven't. They're less worried now about velocity and they're more worried about price. So I think it'll be a very, very hard argument to get consensus on moving that terminal rate to 3% from 2. It'd be a hard thing to do, Scott. Quite a lot, yes, sir.
Steve?
Yeah, what do you think the fallout will be with, what happened with Silicon Valley Bank as it relates to?
I think you're going to see small regional banks will combine. There's no doubt about that, and you'll see more of that. I think, again, you need to look at it and say, were the changes made to Dodd-Frank appropriate? Or so you went from, you have to undergo a stress test, you had 100 billion in assets. Under the last administration, they changed it to 250 billion. All of a sudden, a whole bunch of banks aren't stress tested anymore. Look at what's going on in the crypto world right now. I mean, it does argue. If you look at Bitcoin, it's trading, what, 24,000 today? It's now, some people say, well, perhaps this is now a viable reason why we can move away from fiat currencies. I am not a believer. I think it's a Ponzi scheme, personally speaking, but that's just me, I'm old. But you are seeing more interest in that now. But also at the same time, however, you have a lot of these currency entities that had money deposited with those couple of banks. They're going to be made whole by the Fed, thank you very much, on their new terminal deal they put together for the next 12 months. But there'll be a move to large banks, and that's going to be a problem, because that's going to raise interest rates. And you'll also see some more merging of regional banks. That, I think, are the two things that you will see occurring. But does anyone expect to see a systemic risk of the entire system based upon the events of last weekend? No. No one's expecting that at all. And at the same time, it made sense for this new facility to be created by the Fed for 1 year, and they'll buy bonds on face value. But we just need to look at the exposure. And again, you have to blame the Fed. No one expected that they were going to raise rates as fast as they did. So all of a sudden, bondholders you can't sell them, right? Because they're worth half of what you paid for them. So those are the things I would expect to see occurring. And of course, you're going to see Congress jump and leave and do what they do. But ultimately, yeah, it has the potential to raise interest rates because of the fact all of a sudden more people will be going to the big 13 banks. Scott.
Hey.
Hey, Matt.
Hey. So, in your base case assumption, what is well, you didn't have a base case too, but what's your base case assumption on Ukraine?
Oh Lord.
For 2023, is it? I mean, you have to decide something. I mean, up, down, sideways.
Right now, last I read, which I think was middle of the night last night, Russia is now sending female prisoners to Ukraine to fight. This is no joke at all. They've already been pulling people out of prison saying, you're either going to fight or we're going to double the amount of time you spend in jail. They've hit all the lunatic asylums, they've got all those guys out. The big question is really going to be is going to be down to Putin. I mean, this is his last play. So
you'd assume that the war would continue all through 23?
I think that it would be unlikely it will end unless NATO puts boots on the ground in Ukraine, and that's very, very, very unlikely. If they do that, it's that'd be as bad as China heading into Taiwan. Nothing good will come of that, as much if it happens. So yeah, I think we'll continue for a while longer. I think we'll continue both NATO, all NATO nations will continue to feed Ukraine. It's something which, quite frankly, I think Putin just didn't think about. He said this is going to be an easy deal, be done by Christmas. That doesn't quite work out that way. So yeah, I don't think we'll see a conclusion to it this year. That's going to be an issue as well, by the way. If you look at semiconductors, the rare earth metal and gas that go into most of them are provided by two countries. One's Russia, one's Ukraine. So it's going to be an issue in that respect as well. So ultimately, I don't see a happy ending coming this year. I just think he's put in a situation now whereby he can't step backwards. And so if it was to stop, it would only be because of one reason, and that's an uprising in Russia, which will require approximately 5 million Russians. And a whole bunch of oligarchs have lost a whole bunch of stuff, including a Fabergé egg, by the way. They found a Fabergé egg on someone's 500-foot yacht. Makes you wonder. So oligarchs and the normal human beings, that you could see him be overthrown, but that's a long shot.
We might have to set up a GoFundMe for the oligarchs. It's
Yeah.
been a tough go for that.
They are really.
They're steamed.
I got one more quick one. So there's a lot of, well, more on the press. You're reading now about the big tech employers boarding because they're carrying employees because they're in fear of losing talent that they may not really need right now, but they're more concerned about whether they can replace this talent. And I mean, you have a view on how big that is, because, I mean, that could hit.
Well, yeah, it could, but I certainly have not heard that. The reason why I say that, if you look at the layoffs that have been announced on those charts I showed you already, that tells me, and certainly they can be the publicly traded companies, right? Because they're as good as their last quarter results. And they're trimming a lot, announcing a lot of that fat, including down later another, this morning's announcement of another 10,000 across that, whatever you think about the metaverse and what have you. So given what Amazon, what those guys are doing, and it's far less in the real estate entities, like the Redfins and the Compasses, that's actually eviscerating their technology groups, not the actual brokerage part. Yeah, if someone's saying they're doing that, I'm not sure who they are, because a lot of the ones that we're reading about now, those announced layoffs are coming from some very big players in that space. But at the same time, people being laid off, by the way, in that sector. I was reading a report, Indeed.com, who's saying that 40% of them have already got new jobs, and almost all of them making more money in their new jobs than they were at their old jobs. It's not a case they're going unemployment, sitting around eating Cheetos. They're working again. So you talk about a loss coming out of these businesses at the same time. They're going somewhere, they're doing something. So it's not a case of kind of eviscerating that entire region. I just haven't heard about keeping people on just because I can and I need them. I think there's a lot of smart kids going through school right now that I'm sure would love to get there, unless they're senior engineers. But I don't know that.
It's really difficult to replicate.
Well, it's true. Yeah, I just haven't heard that people are being kept on just because they can, especially given the announcements that have been made already.
I think we're out of time. I'd like to thank Matthew for his time here today. Again, thank you all very much for coming. We are going to stick around for another half hour or so if you want to stick around and chat, we're always available. We're really excited that we're staying very active this year, so please reach out to us. None of us are tremendous golfers, so we're in the office every day, and we'd love to see you guys doing